Your unused sick leave at retirement actually adds into your years of service, which then increases your pension. Today, we're going to talk about exactly how it works, how to calculate how big it's actually going to make your pension, and if it's worth actually hanging on to it or maybe burning it before. We'll talk through all of those details. And we'll get my slides up so we're ready to rock and roll. If you're new to the channel, though, welcome. My name is Dallin Hawes on Financial Planner. I serve feds every day. Absolutely love it. Let's dive in. So we're talking about, of course, sick leave, unused sick leave at retirement. Now, I talk to so many feds that have hundreds, if not thousands of hours of sick leave and they're approaching retirement. They're trying to figure out what to do. Well, let me talk you through what happens if you just leave it on the books and what happens if you potentially don't. So let's say that you've got about 2,000 hours of sick leave. And again, this happens all the time. I see feds that have had long careers. They haven't really used sick leave throughout, and they've got a whole bunch left. What they can do is any unused hours will actually add into your years of service to therefore increase your pension, because your pension is based on how many years of service you have. So the more years of service you have, the bigger your pension. Let me give you an example of how this actually works in practice. Let's say you've got 20 years, 2 months, and 15 days of just normal time, right? This is time you actually worked. Let's also say that sick leave, let's say it's worth 3 months and another 18 days of time. Now, if you want to know how many hours actually equals months and days, basically this is how it works. About every 2,000 hours of sick leave is a year's worth. So 1,000 hours is about 6 months. About 500 hours is 3 months, etc. You can kind of do the math based on that. So you can, and honestly, if you just Google sick leave conversion chart, you can see a chart that'll actually break it down exactly how much it is worth. Once you've done that, you can then add it to your normal years of service. So in this example, this would be 20 years, 6 months, and 3 days. Now, the way this works is days will actually, basically, a month is always considered to be 30 days when doing this sort of math, regardless of what month you're retiring. That's just how OPM works. Okay. So once they add this all in, any extra days at the very end, those actually drop off. They're not worth anything. The only thing that's going to be applied for your pension is total years and total months. So the whole idea being you don't want a bunch of extra days left over if you can help it. I'd probably recommend having a couple just to make sure you have enough buffer, but you don't want 20, 25 days left over. At least I wouldn't, because that's time that doesn't actually count towards your pension. So once they get your total years and total months with your sick leave, that is what they'll base your pension on. Now, let's do an example to give you a sense of how much this might impact your pension or not, because for some people, it's honestly a little underwhelming, but let's go through an example just to see how this might work for you. Let's say you've got 30 years of service, just as an example. Let's say your high three is $100,000, because it keeps my math nice and easy. And let's say your multiplier is 1%. Now, if you're not familiar with how your pension is calculated, I've got whole videos on that. Let me go through an example, though. If this was your case, you'd have 30 years multiplied by $100,000 as your high three salary, multiplied by 1%, okay? So this would be, your pension would be $30,000 a year. This, I'm assuming, is before sick leave. Now, let's say you've got 2,000 hours of sick leave. And so instead of 30 years, you have 31 years. Let's say it adds an entire year to your calculation. So instead of this being 30, it is now 31, meaning instead of you get 30,000 a year, you get 31,000 a year. 31,000 a year. So every year it's an extra $1,000, but every month we're talking maybe $85 or so. So having the 2,000 hours increases your pension by about $85 per month, which is not a ton, but there's a couple benefits. Number one, it's for the rest of your life. Number two, it gets cost of living adjustments over time, which is really, really nice. Now, for example, your annual leave, if you didn't know, obviously today we're just talking about sick leave, but your annual leave is payout in a lump sum, which there's pros and cons to that. One of the cons, however, is that you got to pay a big chunk of that in taxes because it all kind of comes at once. The fact that your sick leave gets spread out over the course of your life is kind of nice, right? Because you don't have to pay tax on it all at once. But even with all that said, it doesn't increase your pension all that much, right? It is not taking any sick leave for 30 years worth a pension that's bigger by $85. Probably not. Probably not. So you can crunch your own numbers because everyone's numbers are a little bit different, but that's ultimately how this works. It'll increase your pension, but of course, you don't want a whole bunch of extra days left off at the end because those don't count for anything. So I hope that's helpful, guys. If you want help with your own federal retirement, trying to maximize all these details, feel free to reach out. We help feds with all this stuff every single day. We love it, and we'll see you in the next video.